June ended the financial year on a semi-positive note for most markets. The US was a little bit flatter than others. Starting to see a better breadth of movements in markets beyond just those market leaders that we've seen in the US. If we look at the financial year though, if we have a look at global markets, they were actually relatively positive given the headlines and the negativity that you have seen through the year. So as we've been speaking about, we've had clearly the geopolitical tensions escalate. We've had the tensions in the Middle East that have impacted markets. We've had inflation impacts pre and post the escalation in the Middle East. If we have a look, Australia's been one of the laggards, still positive, around 6% positive for the 12-month period. We have a look at the US markets, they're up sort of 12 to 15% across most of the broader indices. We then have a look at some of the other markets, and you look through Europe and there's a better breadth of growth coming through. And then having a look through emerging markets and the Japanese markets as well, they've been very sound in terms of positive outcomes for the year as well. So while the headlines can be challenging and can be difficult to work with and live through, I suppose, if you take a longer term perspective, and markets generally look through some of these headlines and short-term impacts that do impact sentiment and confidence, we've actually had pretty resilient outcomes from most markets. June saw a change of focus for markets, with the geopolitical situation seemingly settling down. As that had escalated, markets had been assessing what the likely impact was going to be. So clearly energy markets and oil prices spiked, and we've seen that ease now. So if we look at the last quarter, that's been one of the worst performing sectors of the equity markets, and certainly has eased in terms of a commodity pressure for what's flowing through to economies. And then thinking about the longer term impacts of those energy prices, there is still expectation that inflation hasn't yet peaked or it will remain high for a period of time, and we've seen that domestically. Clearly the central bank here has been willing to move and act to try to take some of the heat out of prices. Thinking about fixed interest, that has played a limited role in terms of what the positive outcomes have been in that market. So fixed interest bond returns have been in the order of sort of 1.5% to 2% domestically, about 3% overseas. So while interest rates have been higher, because of the volatility that we've seen in expectations around inflation and expectations around what central banks will do, we've seen relatively flat outcomes come through from those elements of portfolios. So it has been a little bit of a diversifier, but not the return generator that you may have expected given yields have increased. Now, going forward, you've got to look at fixed interest markets in a forward-looking sense. With rates at a higher level, you'd expect that sort of return to be generated over the next sort of 5 to 10 years. So that 4 to 5% yield that you're getting from conservative assets like bonds that are issued by the government. Some higher yielding sectors would be generating better returns from that. From an Australian dollar perspective, it was relatively flat in the month. The expectations or the markets were looking at interest rates and the interest rate differential between Australia and the US, and that closed a little bit in the month. So the expectation from the Fed was that they were potentially going to cut a few months ago, to now looking through the inflation and the inflationary impacts that are going through the economy there, and the expectation now is that there's potentially an interest rate rise in the near term for the Fed. And so that difference and the expectation that Australian central bankers may almost be at the end of their hiking cycle started to converge the differences between the US expectations, the Australian expectations, and then therefore that was something that had a negative impact on the Aussie dollar. If we look more broadly in that sector or the technology sector, we're starting to see a broadening of the players and the winners in that space. So the mega cap technology businesses that had certainly been winners in the AI race, That's now starting to broaden beyond the top 7 or 8 type businesses that we're seeing in the world, and not just in the US, but you're starting to see that broaden out into other parts of the world as well. So Korea with some of the chip makers and the memory makers. You've got some of the beneficiaries in Europe as well, where companies had effectively been left behind from a valuation sense. Another linkage to the AI boom is broadening out into the energy grid and also the infrastructure side of things as well, in terms of data centers and those areas that are related to the AI boom. So that's another part of the market that has performed well. One that's of interest as well from our perspective as well is the property side of things. But the supply-demand dynamics in that part of the market are interesting to watch. So if you have a look around the world, certainly in Australia, there's not a lot of new supply coming in to certain parts of the property markets. At some point in time, that'll play out with some uplift in valuations for some of those parts of the real assets that have been left behind for a number of years. So that's one that we're watching, and think there's some opportunities in that part of the market as well. For the outlook, fundamentals are always something that we consider and think is relevant for long-term investing. So sentiment can move things quite quickly in the near term, and that's very short-term focused and trying to take advantage of movements and sentiment and behaviours. Over the longer term, fundamentals are what drive markets. So like that property example of supply and demand, knowing what is likely to come into markets from a supply perspective, which will ballast or be fundamental in terms of impacts to the market in terms of rents and vacancies and those sorts of things. So from an equities perspective, it's making sure that companies are generating sound earnings.